A major geopolitical headline is ripping across social media tonight. Claims that Venezuela's president, Nicolas Maduro, has been captured after US military action. Right now, this is not fully verified, and that matters because markets don't trade truth, they trade uncertainty. So in this video, we're not going to speculate. We're going to do what we always do on this channel. Ignore the noise, track the signals. I'm going to show you the market dashboard for what a Venezuela shock typically hits first: oil, the dollar, volatility, and hard assets. And then we'll walk through two fork-in-the-road scenarios that decide whether this becomes a short-term spike or a multi-month regime shift. Let's separate two things. First, the headline. Reports are circulating, sparked by a social media post from former President Trump, claiming Maduro was captured after US action. As of now, official confirmation is unclear, and that's the whole point. Markets hate uncertainty. Second, the leverage point. Venezuela isn't just a country in markets. It's an option on global energy supply because it holds the world's largest proven oil reserves. Even after years of sanctions and underinvestment, it still exports meaningful volumes of oil. So the market's first reaction is simple. Is supply at risk tonight? This is the first wave. Sell first, ask questions later. Your wave 1 dashboard is oil, Brent/WTI, the fastest transmission channel for geopolitical risk. VIX, the fear gauge, which spikes when investors rush to buy protection. Readings above 20 are considered elevated, and a shock like this could send it much higher. USD plus Treasuries, the classic flight to safety bid as investors seek safe havens. Energy equities tend to pop with crude as their potential profits rise. Airlines/transports tend to get hit because of their sensitivity to higher fuel costs. In wave 1, the market is not doing analysis, it's doing survival. After the initial spike, smart money starts asking, is this a temporary risk premium or a structural change? These are the signals to watch over the next 24-72 hours. Does oil hold the spike, or does it fade as more information comes out? Does the VIX spike and then start falling, signaling that fear is burning out? Do credit spreads widen, indicating that stress is spreading into funding markets? Does the dollar surge and then stall, suggesting the risk-off move is cooling? Translation: if fear peaks and begins to cool without new escalation, wave 2 becomes a mean reversion and selective buying window. Here are the two regimes that could follow. Scenario A, chaotic transition. If there's a power vacuum, civil unrest, or risk of sabotage to oil infrastructure, the geopolitical risk premium that caused the initial price spike stays elevated. In this world, oil prices remain high, which could re-accelerate inflation expectations. Defense stocks and hard assets like gold stay bid. Broader equities face an uncertainty discount. Scenario B, stabilization. If you get a stable transition and a path towards sanctions normalization over time, the market starts pricing in a world where Venezuela's oil production can recover. This is a longer-term narrative, but it's powerful. The country's oil is primarily extra-heavy crude from the Orinoco Belt, which requires specialized processing at refineries like those on the US Gulf Coast. A stable return of this supply could eventually pressure oil prices lower, flipping the initial price spike into a long-term narrative of more supply. Let's bring it home by assigning jobs to different assets in your portfolio for this kind of event. Gold acts as a confidence hedge against geopolitical stress and questions about systemic credibility. Oil/energy. This is the direct transmission channel for the shock, impacting inflation and growth expectations. Defense serves as an escalation hedge, pricing in the potential for increased military spending. Bitcoin acts as a liquidity play. Its performance depends on whether the shock triggers a tightening of financial conditions or expectations of future easing. Gold is the confidence hedge. Oil is the shock absorber. Bitcoin is the liquidity play. So here's the takeaway. The headline may change, the dashboard doesn't. Watch oil, volatility, credit spreads, and the dollar, and let the market tell you whether this is just wave one panic or a real regime shift. In the next video, we'll apply this exact framework to the bigger geopolitical fracture shaping global energy flows, and how smart money positions before the crowd realizes the regime has changed.